copper just continues to go through the roof at this point for all these reasons that I've talked about. Silver's going to play along, okay? And that's this whole spread between Shanghai and COMEX is going to continue to widen, and it's going to force the price higher. And so I tell everybody all this just so that as further argument that even though price for silver is at 11-year highs, it's probably going higher.
You're watching Silver News Daily. Subscribe for more. Did you know that silver prices could skyrocket to $550 an ounce? I know it sounds unbelievable, but Craig Hemke, a well-known expert in the precious metals market, has made this bold prediction. In today's video, we're going to dive deep into why he believes this could happen and what factors are at play. From market manipulation to the growing influence of central banks, there's a lot to unpack. So if you're curious about how silver could reach such heights and what it means for you, stick around. You definitely don't want to miss this.
So therefore, we don't want price going below a certain level today, that sort of thing, or above a certain level, whatever. If that's the case, again, what I'm implying here is a lot of the physical delivery is kind of just in time, if you will. It's not like there's this big stockpile of physical metal and they're like, hey, we just got an order for 2 metric tons. So put it on a truck and drive it. You know what I mean? But there are demands for physical metal. We've seen, the global central bank demand, that sort of thing. All right, anyway, long answer. This is how copper works too, okay? At least in my impression. So why is all of a sudden copper going crazy? Well, there seems to be a supply issue. You can see it in London where we hit 11 new all-time highs, $11,000 a ton about a week ago, okay? And on 2,200 pounds in a metric ton. So the COMEX price got to 515 or something like that. New all-time highs. What's going on here? Well, Goldman Sachs, about a year and a half ago, was writing about global copper stockpiles, above ground copper stockpiles going extinct by last summer. And they're writing about, price going to 10,000 a ton and maybe 12,000 a ton. Well, maybe that's starting to happen. I don't know if you saw, maybe some of the people listening will remember this a couple of weeks ago. When copper got above 5, 10, 15, they were talking about a big short squeeze in the COMEX and how maybe they'd have to divert some copper concentrate to New York. It was an article in Bloomberg. They're going to cover for these naked shorts and all this kind of stuff. And I'm like, if copper's in that short of supply that they got to divert, ocean vessels to New York, and COMEX copper isn't really even shipped or stored in New York anyway. But if it's in that short of supply that they're talking about that kind of stuff, maybe they do have an issue. And two things have happened in the last 6 weeks. And there's a point to all this, I promise. Back in the middle of April, the U.S. and the U.K., hey, sanctioned Russia again. Where have you heard that story before?
Now let's talk about market manipulation. You might be wondering, what exactly is market manipulation and how does it impact silver prices? Well, market manipulation in the precious metals market involves actions by large financial institutions and traders to artificially influence the price of metals like silver. This can be done through various means, such as placing large buy or sell orders to create the illusion of supply or demand. For example, there have been numerous instances where banks have been fined for manipulating precious metals markets. They do this to benefit their trading positions, and it often results in prices moving in ways that don't reflect the true market conditions. This manipulation can keep prices lower than they should be, making it harder for investors to realize the real value of their assets. In the case of silver, this manipulation has been a significant factor in keeping its price suppressed. But as more people become aware of these tactics, the potential for price corrections grows. Hemke believes that once these manipulative practices are fully exposed and addressed, silver prices could surge dramatically. So understanding how market manipulation works is crucial for any investor. It helps you see why prices might not always make sense and why there's potential for significant price increases when these manipulations are corrected.
And said COMEX and the LME would no longer accept Russian copper for delivery as a delivery of metal source. Aluminum, tin, a couple others too, but copper. The other thing was, if you go back, the largest copper mine in the world is in Panama. It's a big, mainly open pit thing called Cobre Panama. And it produces 1.5% of the world's copper supply. And the new Panamanian government was frustrated by the deal the previous Panamanian government had signed with First Quantum to operate that mine. And so they shut it down. 350,000 metric tons of copper a year taken offline. So all of a sudden, is there no copper? Is that what's going on with price? And so ultimately, why am I telling you this whole story? Because frankly, even though we all invest in silver, and Miles Frank, great place to go to get physical silver as an investment. Silver has more in common in 2024 with copper. There's an investment demand like there is for gold, but silver, by far and away, more use comes from, it's an electrical component, right? It's a conductor of electricity, that kind of thing, green metal. So silver's got more in common with copper. If copper just continues to go through the roof at this point for all these reasons that I've talked about for the last 27 minutes or so, silver's going to play along. Okay. And this whole spread between Shanghai and COMEX is going to continue to widen, and it's going to force the price higher. And so I tell everybody all of this just so that as further argument that even though price for silver is at 11-year highs, it's probably going higher. And you want to be regularly accumulating it so that you're buying on dips and you're buying on highs. But the main thing is you're buying because it's probably going higher.
All right, let's dive into the role of central banks in the silver market. Central banks have a massive influence on precious metals, including silver. They hold vast reserves of these metals, and their buying or selling activities can significantly impact prices. Over the past few years, we've seen central banks around the world increase their purchases of precious metals. For instance, countries like China and Russia have been buying large quantities of gold and silver to diversify their reserves away from the US dollar. This trend is important because it shows a growing demand for precious metals as a safe haven asset. Central banks buy silver for various reasons. It's not just about investment. Silver has industrial applications that make it a strategic asset. For example, silver is used in electronics, solar panels, and even in medical devices. As these technologies grow, the demand for silver increases, and central banks are aware of this. When central banks step up their purchases, it reduces the available supply for the market, pushing prices higher. Hemke argues that this increased demand from central banks is one of the key drivers that could propel silver prices to $550 an ounce. So the actions of these financial giants play a crucial role in shaping the future of silver prices. Understanding this dynamic helps us see why silver has such potential for growth and why experts like Hemke are so bullish on its future.
Well, it's been quite an interesting year so far, that's for sure. We began the year at kind of a peak optimism in terms of rate cut expectations, and the dollar index was down to 101, and all of that seemed to be a little too aggressive, given where we were economically. So as the year started, you had to figure, okay, at least the first couple of months are going to be kind of tough for gold and silver. And they were kind of tough. I mean, gold and silver both going down for maybe till about Valentine's Day. And then gold started to perk up. It actually then formally broke out of about a 3.5-year price range back on Friday, the 1st of March, rallied $100 the next week on, just people being enthusiastic and seeing that breakout. And then, we're up another couple $100 from there. Again, in the face of dwindling rate cut expectations and a rising dollar. So that was all, caught even me. I mean, I was caught kind of flat-footed by that too. I was expecting, maybe this will happen by summertime, as it's pretty clear the economy is slowing, but instead it takes off. Silver waited about a month, was watching what gold was doing, and then said, okay, I want to play along too. And so on April the 1st, silver took off. And now here we are 8 weeks later, and it's gone from about 24.50 up to 32. So what's that, 30 some odd percent? It too has now broken out of that about 4-year trading range, and that's gotten a lot of people's attention. That the tough thing I shouldn't say tough thing. The challenge to remember is that even though the pricing ability is demonstrably shifting east, it hasn't fully shifted there yet. And as long as the derivative and the paper markets are still playing a role in London and in New York, you're always going to move up in stages. So yes, it's great. Silver's broken out. Yes, it's fantastic. It's $32 an ounce, but that does not mean it's going to be $62 an ounce by the 4th of July. Okay. That's not how it works, man. And you mentioned part of that. Then again, you get you get rally, get people to come in, and then price kind of rolls over, and then it kind of flushes back out and then pulls back, and then it's ready to move up again. And that's just kind of the ebb and the flow of how price is discovered when you trade derivatives to do that. And so we should still continue going higher from here, but it's this, not straight up like some people would hope.
Next, let's talk about the growing industrial demand for silver. Silver isn't just a precious metal for investors. It's a crucial component in many industrial applications. Its unique chemical properties make it indispensable in various industries, from electronics to healthcare. For instance, silver is a fantastic conductor of electricity, which is why it's used extensively in electronics. Think about your smartphones, laptops, and even electric cars. They all rely on silver. Additionally, the push for renewable energy has skyrocketed the demand for solar panels, which use a significant amount of silver. As the world moves towards greener technologies, the need for silver continues to grow. But that's not all. Silver is also used in the medical field. It has antibacterial properties, making it valuable in wound dressings and medical devices. The biotech industry constantly finds new uses for silver, further driving up its demand. What's interesting is that once silver is used in these applications, especially in electronics and medical products, it's often not economically viable to recycle. This means that the silver supply diminishes over time, while the demand keeps increasing. Craig Hemke points out that this growing industrial demand is a major factor that could push silver prices higher. As more industries discover and rely on silver's unique properties, the pressure on the available supply increases, setting the stage for potential price surges. This industrial aspect makes silver not just a precious metal, but a vital resource for future technologies.
You mentioned you and I met back in 2013. Heck, we were talking about this back then. This was always part of the rationale for stacking your own physical precious metal, was to get it out of the banker's hands. Don't let them leverage it. We can all have discussions all day long about how many times 1 ounce is levered. The 1 ounce has 10 claims against it or 20 claims against it, 100 claims against it. Who knows? But as a way of unlevering or forcing an unlevering of that system and getting to some kind of true price discovery for a physical metal, that's always been, hey, everybody do your part. Buy 100 ounces here, buy a tube of Eagles there, that sort of thing. And that's ultimately what, where is that breaking point? Because I don't think the vaults have to go to zero, right? Because they're not going to go to zero. I don't think you're going to get a report out of the LBMA. We are in desperate need of silver. Please sell us some of yours because we've got commitments and we can't hit the SLV for metal anymore or whatever. Instead is that breaking point that you mentioned, my friend. It's that point at which you get almost like a bank run. This crisis of confidence. Again, think of the global current, at least, precious metals pricing scheme, a little bit like your local bank, right? You go deposit your $1,000 in the bank. They don't just stick it in the vault, man. They make loans. They loan out 900 of it, and they keep enough cash on hand so that you can walk in there and say, hey, I need $1,000 because I'm taking a trip to Vegas. But they don't keep, they're not fully, all of their assets are not fully in the vaults, right? And so what happens with a bank run, like we saw with Silicon Valley Bank or some of these others a year ago, is people lose confidence that they can walk in at any time and get in. And they're like, hey, I want my money now. I don't trust this. They don't trust. At some point, you don't trust that you can get your money out of the bank. And so I'm not going to wait around until, I'm 250th in line, right? And that's a bank run. And that's that tipping point you said. At what point does this hyper-levered Western fractional reserve pricing scheme reach a point of no confidence? And then that's when, they don't have to be at zero. We don't have to have no metal for that to reach that tipping point. We just don't, when will that point be coming? And that's all part of this juggling act that the banks have.
Now let's dive into the supply constraints facing the silver market. One of the most compelling reasons behind Hemke's prediction is the tightening supply of silver. Unlike gold, which can be recycled and reused, silver often becomes impractical to recover once it's used in industrial applications. For example, when silver is used in small quantities in electronics or medical devices, it's difficult and costly to extract it for reuse. This means that as silver is consumed in these industries, the available supply gradually decreases. Moreover, new silver deposits are becoming harder to find and more expensive to mine. This makes it challenging to meet the growing demand. Another critical factor is that a significant portion of the world's silver production comes as a byproduct of mining for other metals like copper and zinc. This means that the supply of silver is indirectly affected by the demand and production levels of these base metals. If mining for these base metals slows down, so does the production of silver. These supply constraints are crucial because they create a situation where demand can outstrip supply. When this happens, prices can rise sharply. Hemke believes that as the market starts to realize the scarcity of silver, we could see a significant price jump. This scarcity, combined with the increasing demand we discussed earlier, sets the stage for potential dramatic price increases. In short, the dwindling supply and the growing industrial demand are like a ticking time bomb for silver prices, making it a very attractive investment opportunity right now.
Left alive that can Joe Biden maybe that can remember a time when the dollar wasn't the world's reserve currency, right? It just, I mean, we're going back to 1944 or 5. I mean, all the World War II veterans are all dying off, they're just, and so it's like, well, it's always been this way, so it's always going to be this way. No, it's not what history would suggest. And as you point out, there are a couple of things that have happened last couple of years that are like, the term dying by 1,000 cuts kind of thing. These are pretty substantial cuts. Back in March, right after the Ukraine war started, back in March of 2022, the U.S., as a way of sanctioning and punishing Russia, froze their non-domestic foreign currency reserves and kicked them out of the SWIFT system, which is the international payment system. They allow you to do business internationally, thereby kind of making the impression that you better play ball. You don't want to get it doesn't matter what you think, what anybody listening to us thinks about Ukraine and Russia and all that kind of stuff. What matters is what the Russians think in this case. And if they look back and other countries go, let's see here, if we ever get sideways with the U.S., they're just going to kick, and it's inevitable we're going to get sideways with the U.S. because we have our own national interests that we're going to pursue. And at some point, the U.S. is probably going to decide that's counter to the U.S.'s, and therefore they're going to kick us out of SWIFT and seize our foreign currency reserves. So when that happened, that was a real blow to U.S. dollar hegemony, if you will. It doesn't mean it. Obviously, the U.S. dollar is still the most widely used thing in global trade, and by far the largest held item in foreign currency reserves in the world. But it definitely, the events of early 2023 or 2022 it kind of spun the wheel towards getting rid of the dollar, de-dollarization a little bit faster. And so where do we stand now? We've got all this talk about whether the BRICS countries, Brazil, Russia, India, China, South Africa, go down the list, how many BRICS plus, whatever you want to call it, are going to come up with an alternative to the dollar. Not something, it's not because I see this a lot too. It's not like this binary thing. It's like one day it's a dollar and one day it's something else. No. It's just it's an alternative. It's competition to the dollar. And if China and Russia and India and go down the list have a unit that they can conduct international trade in, that they have confidence in the value of it, not fluctuating up and down 20% in a month, but it stays relatively stable. They have confidence in that unit. They're going to use it. And if by using it, you decrease demand for dollars, right? And your audience is smart. They probably understand the supply and demand. You got supply, you got demand, and where they meet is price. Well, if you increase supply, which is what we're doing day after day, month after month with more and more debt, while at the same time you are decreasing demand by virtue of these alternative currencies, well, then the value of said good falls. The price falls.
Let's take a look at the historical gold to silver ratio and what it means for silver's current valuation. Traditionally, the gold to silver ratio has been used by investors to determine the relative value of these two precious metals. Historically, this ratio was around 12 to 1, meaning 12 ounces of silver would buy you 1 ounce of gold. However, this ratio has fluctuated significantly over the years. In modern times, the ratio has ranged from as low as 20 to 1 to as high as over 100 to 1. As of January 2024, the ratio was around 87 to 1. This high ratio indicates that silver is significantly undervalued compared to gold. Many analysts believe that silver should be trading at a much higher price, given its industrial uses and the increasing demand we discussed. Hemke highlights this historical context as a key indicator of silver's potential for appreciation. When the gold-to-silver ratio is high, it often signals a good buying opportunity for silver, suggesting that silver is undervalued relative to gold. Historically, when the ratio corrects, it means silver prices increase at a faster rate than gold. For instance, if the gold price remains stable or rises modestly, a correction in the gold-to-silver ratio could see silver prices surge significantly. This potential for correction provides a strong argument for why silver could see dramatic price increases in the future. By understanding this historical ratio and its implications, investors can gain insight into the potential for silver to rise sharply in value, making it an attractive investment. Hemke believes that as the market corrects this imbalance, we could see silver prices move much higher, supporting his bold prediction of $550 per ounce.
They don't just take your $10,000, put it in an envelope and put it in a safe and say, this is Bob's $10,000. It doesn't work that way. That client lady you're talking about, what'd you say, it was $50 million?
Mm-hmm. Yeah.
Oh my gosh. That's a few multiples above and beyond the FDIC insurance.
Mm-hmm.
But they've loaned that out, right? So they've got, if it's in treasuries, heck, they probably have $500 or $450 million of treasuries that they bought with that. They could do anything with it. At least they can just loan it out in commercial loans. So they don't have that cash sitting there on hand. And so, if you need some, then you can show up and they'll get it to you, but they don't. And again, this gets back to that kind of normalcy bias that you and I have talked about before, and this has to do with just about anything. Well, tomorrow will be probably just like yesterday. There's nothing to be worried about. And there aren't stories of people having $1 million in the bank and only getting $200,000 back. There aren't. When there's any of these recent bank failures, the FDIC swoops in, they maybe park the bank, JP Morgan absorbs it or something like that. Or if the bank just goes out of business, they just pay off everybody up to whatever that $250,000 level. So there aren't a lot of stories about people just getting, completely wiped out. And so therefore they think, well, it's really not that big of a risk. But man, when it all begins to accumulate, especially at the regional bank level with their exposure to commercial real estate over the next couple of years.
Mm-hmm.
Now let's explore the trends in retail and institutional investments in silver. Over the past few years, we've seen a significant shift in how both individual and institutional investors view silver as an investment. For retail investors, silver has become increasingly attractive, especially among younger demographics like millennials. Many young investors are looking for tangible assets to diversify their portfolios, and silver fits the bill perfectly. The Royal Mint, for example, reported a 200% jump in demand for precious metals among young investors. This surge was particularly notable after the crypto crash, as many turned away from digital assets in favor of physical metals like silver. Institutional investors are also playing a bigger role. Central banks, hedge funds, and large financial institutions have started to increase their holdings of silver. This is partly due to its undervalued status and the potential for high returns as demand grows and supply constraints tighten. Hemke emphasizes that these investment trends are critical for understanding silver's future. The combined buying power of retail and institutional investors can significantly drive up prices. When large institutions buy silver, they often do so in massive quantities, which reduces the available supply for the market and pushes prices higher. On the retail side, the growing interest in physical silver, bars, coins, and even fractional ownership options like DigiGold indicates a strong and sustained demand. This trend towards increased investment in silver by both individuals and institutions is a key factor that could propel prices to new heights. As more investors recognize the potential for significant gains and the security that silver offers, we could see continued upward pressure on prices. In short, the rising demand from diverse groups of investors adds to the bullish case for silver, aligning with Hemke's prediction of a substantial price increase.
Opposed to each other. Somehow they're mutually exclusive, but they're not. The bullion banks can manage and manipulate the price of the precious metals to certain price targets almost on a daily basis. But that doesn't mean price can't go up. I mean, that evidence is right staring you in the face, right? Gold's gone from $400 to $2,400 in the last 20 years. But the bullion banks, they're still at JP Morgan Global Precious Metals Desk, right? There's still Citigroup. There's still, UBS, Goldman Sachs, go down the list. So there's money to be made. What they can't have is a 50% year. That'd be catastrophic. I think the best year we've seen, while we've gone from 400 to 2,400 is about 25%, 28% back in 2011. Okay. They can manage 10%, 30%, 50% is a whole other deal. And that gets back to what you mentioned earlier, Dunnigan, about the four heads of different bullion banks, these trading desks, JP Morgan and HSBC, and I can't remember what the other two were, all ran over to Shanghai back from a period of late March into early April. I mean, there's Reuters stories on all four of them. Some of them use the same picture. And that they're just caught in a jam now in silver, in that, we get reported through the CFTC their gross positions, and you can compute the net positions every week with the commitment of traders reports. We know from that data as a group how much net short they are, not even including the producers that are allegedly hedging or selling forward, just what are called the banks, the swap dealing banks. They're currently net short about 40,000 contracts. What, 5,000 ounces a contract? That's $200 million. And you're like, well, wait a second. Every dollar that the price goes up, then that's $200 million in losses. So you think, okay, well, they've got an incentive to keep price in check. But the problem, if they keep their price, the New York price in check, and the Shanghai price keeps going like this, well, now that an arbitrage opportunity develops, and all of a sudden the silver that is backing the exchanges, and all their derivatives and the leverage there, all of a sudden they risk losing some of that. So it's like, okay, we can either keep the price low to keep our paper short position from, accumulating a couple $1 billion in losses, or we could risk kind of an existential event and have our vaults get drained. And so that's what I mean, kind of a rock and a hard place. Now, one last thing though on that. To you and me, it sounds simple, right? It's like, hey, look, Shanghai last night was trading $36 an ounce. And in the US, it's 32. So a simple arbitrage is you buy in the US and you sell in Shanghai. US price goes up from the buying, the Shanghai price goes down from the selling, and and you close that gap. Well, is $4 enough to make that profitable? Is $4 enough to take the risk? And that's something that when I hear people or read people talking about this potential arbitrage, I think gets left out, because to execute that trade and to close that gap, you have to buy in the West and sell in Shanghai. Okay, well, if you're buying in the West for future delivery in Shanghai, you better be darn sure you can actually get your hands on that metal, much less ship it over there and do everything else, customs.
Let's dive into the broader geopolitical and economic factors influencing silver prices. These external elements play a crucial role in shaping the market and can significantly impact silver's trajectory. First, consider the current geopolitical tensions. Events such as trade disputes, sanctions, and conflicts can create uncertainty in the global markets. For instance, the recent sanctions on Russia have had ripple effects across various sectors, including precious metals. When geopolitical tensions rise, investors often flock to safe haven assets like silver to protect their wealth, driving up demand and prices. Next, let's talk about rising interest rates. Central banks, especially the Federal Reserve, use interest rates to control economic growth and inflation. When interest rates rise, the cost of borrowing increases, which can slow down economic activity. This often leads to a decrease in industrial demand for metals. However, silver is unique because it's both an industrial and a precious metal. While higher rates can dampen industrial demand, they also boost silver's appeal as a safe haven investment during economic uncertainty. Moreover, economic slowdowns and uncertainties can have a profound impact on silver prices. Slower economic growth in major economies like China can reduce the demand for industrial metals, but at the same time, it increases the appeal of silver as a store of value. Investors seek stability in precious metals when the economy is volatile. Craig Hemke points out that these factors, geopolitical tensions, rising interest rates, and economic slowdowns, all contribute to a complex environment where silver can thrive. Despite the potential for short-term volatility, the long-term outlook remains strong as these factors create sustained demand for silver. By understanding the interplay of these geopolitical and economic influences, we can see why Hemke is confident
I think
in his
what has
prediction.
been taking place in copper is more just specific to copper
demand, but also set the
and
stage
the
for
pricing
significant
scheme.
future growth, making silver
The
a compelling
overall pricing
investment
scheme where we're
opportunity.
going to trade, derivatives, futures contracts, and say, this is the price because look it's on CNBC, rather than the actual trading one for one, the physical for the fiat and back and forth. Copper's a very interesting story because, again, it trades in London, where is the actual physically delivered market, but then you got these derivatives that trade in New York. Oh, that sounds kind of familiar, doesn't it? Okay. I have always felt, I can't say this is true, this is my 15 years of watching this stuff, that the daily, maybe not every day, but the price of gold and silver is managed to physical delivery. And what I mean by, let me ask you, you remember the guy Michael Nowak of JP Morgan, who's now currently in federal prison for manipulating? All right, he was the head of the JP Morgan precious metals desk back until whatever it was, 2018. He was also on the board of the LBMA, London Bullion Marketing Association. He's now in jail, actual federal prison, for his role in managing and manipulating the precious metals prices through the JP Morgan desk. All right, so that's kind of think of that as the derivative desk in New York managing the price for the physical desk in London. So London knows where the orders are for physical delivery, and they'll say, they'll alert their trader, the JP Morgan traders in London know this, and so they alert the JP Morgan. I'm just picking JP Morgan as, an easy example. Say, we need price, don't take any lower than this because that's going to hit some orders and physical orders to fill, and we don't have the metal to flow at this level at this point.
All right, we've reached the final step, the apex of our discussion. How all these factors could drive silver prices to $550 per ounce, just as Craig Hemke predicts. So let's pull everything together. We talked about market manipulation, the strategic actions of central banks, the burgeoning industrial demand, the supply constraints, the historical gold to silver ratio, and the rising interest from both retail and institutional investors. Each of these elements alone can influence silver prices, but together they create a perfect storm. Market manipulation has kept silver prices artificially low for years. As more investors become aware of this and demand fair market value, prices are likely to correct sharply. Central banks around the world are increasing their silver holdings to hedge against economic instability and currency devaluation, further driving demand. The industrial demand for silver is growing rapidly due to its essential role in electronics, renewable energy, and medical applications. This demand isn't going anywhere. If anything, it's going to increase as technology advances. Meanwhile, the supply of silver is becoming more constrained. New silver deposits are harder to find, and recycling is often not viable. This imbalance between supply and demand is a critical driver for price increases. The historical gold to silver ratio indicates that silver is currently undervalued. As this ratio adjusts, silver prices can surge, outpacing gold. Additionally, both retail and institutional investors are turning to silver, recognizing its potential for significant returns and its role as a safe haven asset. Geopolitical tensions and economic uncertainties also add to silver's appeal. As global events unfold, silver remains a reliable store of value, attracting more investors looking for security in turbulent times. When you consider all these factors together, it's clear why Hemke believes silver could reach $550 per ounce. It's not just one element pushing this prediction, it's a combination of market forces, investor behavior, and economic realities. So what does this mean for you? It means that silver represents a unique investment opportunity. By understanding the dynamics at play, you can position yourself to benefit from the potential price surge. Don't forget to subscribe to our channel for more insights and updates on precious metals and other investment opportunities. And remember, this is not financial advice. Always do your own research before making any investment decisions.